Welcome to Intermediate Accounting. In this video, we are going to review recording business transactions, debit credit rules, posting journal entries to ledger accounts. So make sure you have your pen and paper or a separate device from that which you're watching this video so that you can take notes as we go along. Where do financial statements come from? You may have heard this crazy rumor that the stork brings financial statements, but let me be the first to tell you that that is not true. Financial statements come from business transactions. Here we see a transaction. A company received $4,000 cash for services performed. The financial statements summarize all of the events or business transactions that took place for the accounting period, whether that period's a month, a quarter, or a year. Financial statements summarize business transactions. A transaction is an exchange between two or more parties. So when Starbucks purchases coffee beans, it increases its raw materials inventory. Then it also has to either decrease cash because it paid cash for those coffee beans, or it now owes its supplier. Every financial transaction is recorded as a journal entry. You know this from your introductory or principles financial accounting class. Here's an example of a journal entry. Remember, it always will have a left side and a right side. Remember that left is the debit, the credit is the right side. We always start with the debit or the left side account. The credit goes below and it's always indented so we can separate which accounts are debited and which accounts are credited. And this is really just the system that is used by accountants when transactions were recorded on paper many years ago. This was the format, so it's the format we follow when we're on a computer system. Really, we just need to identify what account is being debited, and what account is being credited. Remember, on the left side, we start with our debit, and on the right side, we end with our credit part of the transaction. And debit doesn't mean increase or decrease. Debit simply means left side, and credit doesn't mean increase or decrease. Credit simply means right side. So remember, the debit on the left, the credit on the right. And if you have any trouble remembering that, I hope that this song video will help you to try to remember that. And feel free not only to take notes, but also to dance along to the video. Here's your link if you want to watch the whole thing. So here's the summary of what a debit does. Remember, a debit doesn't mean increase. It only means increase if you're talking about specific types of accounts. So we always debit to increase assets, and we always debit to increase expenses. What you don't see here is that we also debit to increase dividends. We credit liability, equity, and revenue accounts to increase those. Or in other words, a debit to a liability, equity, or revenue account will decrease them. Now that's a lot to remember, and it's really important that we know these debit credit rules like the back of our hands. Probably haven't used them in a while, so I want you to right now take out a piece of paper, grab your pen, and let's work through our debit and credit rules. Okay, their debit credit rules go back to our fundamental accounting equation. Assets equals liabilities plus stockholders' equity. And when we think about these debit credit rules, remember, debit is always on the left side. We typically abbreviate debit DR, don't ask me why, and credit CR. So regardless of what type of account, remember, debit means left side and credit means right side, regardless of the type of account. But whether a debit means increasing that account or decreasing depends on how we classify each of these. Remember, we're starting with the balance sheet, each of these three types of accounts. And every account affects part of the balance sheet, affects one of these, either asset, a liability, or an equity account. So now when the double entry transaction system started, somebody had to just decide, let's say with an asset, if I'm going to increase assets, it didn't matter whether that person chose a debit or a credit, but they chose a debit. So for assets, we always debit to increase assets. Every asset account, cash, accounts receivable, inventory, plant, property, and equipment, goodwill, other intangible assets, debit to increase an asset. So and then once you know one of these rules, everything else follows along. If we debit to increase an asset, how could we decrease an asset? Has to be with a credit. So we credit to decrease an asset account. Okay, this is a double entry system. So let's say a company goes to a bank and borrows $100. We would increase cash, so we would debit cash simply because that's our starting point rule. We have to remember debit to increase an asset. Then what happens on the other side? What's the other side of that transaction? We got cash. Nobody just gives us cash. We now owe. So remember, every transaction is going to have at least one left side and one right side. So on the other side of this equation, we have the other side of that transaction. Went into a bank and got $100 of cash. We now owe. So if we debit to increase an asset, we do the opposite when we come on to this side of the equation. So liabilities, we always credit to increase any liability account, accounts payable, accrued liabilities, accrued expenses, long-term bonds, long-term debt. Okay, so remember, debit to increase assets on the other side of the equation has to be increased with a credit. If we credit to increase liabilities, how do we decrease liabilities? Easy. Debit to decrease. Okay, so liabilities and equity, stockholders' equity are on the same side of the equation. So equity accounts equity acts like a liability. We are going to follow the same rules because, so if we issued common stock for cash, remember my last example was going into a bank and borrowing, debit to increase cash, credit to increase loans payable or notes payable. Now let's take the transaction. If we issue common stock, a stockholder's equity account, we debit to increase cash, an asset. We have to credit to capture the other side of that transaction. So equity accounts are like liabilities. If we want to increase equity, we do it with a credit. And if we want to decrease equity, what does it mean to decrease equity? Well, expenses decrease equity, right? Expenses reduce retained earnings. Retained earnings is part of equity. Remember, equity is two main components, common stock and retained earnings. There's more to it, as we'll see later on in the semester, but as a starting point, common stock and retained earnings. When we have expenses, they decrease retained earnings. So how do we decrease equity? With a debit. And as I mentioned up here, let's take that forward. Let's continue with these notes. We have the accounting equation. We know what to do with our balance sheet accounts, but let's separate our equity accounts into their two main components so that we remember every time we see common stock. Now, we're never really going to decrease common stock, not directly. Company might buy its shares of common stock back, but then we use a separate account called treasury stock. We're not there yet. So really for now, all we're going to ever do is increase common stock when the company issues common stock. And the other main stockholders' equity account, as we said before, is retained earnings. We want to credit to increase retained earnings, right? How do we increase retained earnings? Revenues. So revenues affect retained earnings, so revenues, therefore we credit. And how would retained earnings be decreased? They'd be decreased with a debit, but what types of transactions would decrease retained earnings? Two things, expenses, of course, and also, in addition, what else will decrease retained earnings? Dividends. So let's write that out. So remember, we started off with this accounting equation. We drilled down into stockholders' equity's two components, common stock and retained earnings. We can leave common stock alone. We're just talking about issuing shares of common stock, and that's it. But retained earnings, let's drill down into retained earnings. Three things affect retained earnings. Revenue. And what does revenue do to retained earnings? Well, we never really have negative revenue. I mean, we can have some specific accounts that are contra revenue accounts, like sales returns, sales allowances, but for the most part, typical revenue accounts, they increase retained earnings. And how do we increase retained earnings? With a credit. Okay, so we're looking at our retained earnings section, revenues to increase retained earnings, expenses. What do expenses do to retained earnings? Do they increase or decrease retained earnings? Expenses decrease retained earnings. How do we decrease retained earnings? With a debit. Oops. So yeah, so we see this plus sign, a plus, let's say increase expenses, and remember, what do expenses do? They then decrease our retained earnings. One more account that affects retained earnings, but that is not on the income statement, dividends. And what do dividends do to retained earnings? Do they increase retained earnings or decrease retained earnings? Dividends decrease retained earnings. So when we declare dividends, we are going to increase or debit the dividends account. That account will then decrease retained earnings. So there's a lot here, but it's critical. There is some logic to it. Once you remember one item here, everything else flows and makes sense. Let's come back to this summary because it's incredibly important. What does a debit do? It increases assets and expenses, also not shown here, also dividends, and a debit decreases liabilities, equity, and revenue. Remember the rules, every journal entry has at least one account that is going to have a debit. It can be more. If we have multiple debits, we put them all together on that left side when we write out that entry. Debits always go at the top. Once we finish debiting all of our debit accounts, then we record our credits. We indent and put them at the bottom. There's always at least one account, maybe more, that is going to have a credit. And remember, the total amount of the debits must equal the total amount of the credits. Here's an example. When Jonathan Kirk Company purchases a brand new Lamborghini by signing a loan from Rockstar Bank, here's what a journal entry would look like. An asset account, let's say this company uses the vehicles account as one of its asset accounts. We're going to debit to increase the asset account vehicles, and we're going to credit to increase the liability account note payable. After a journal entry is recorded, it must then be posted to ledger accounts. So a ledger account is a record of business transactions related to a specific account. So if you're like me and you maintain a checkbook, as I'm sure many 20-year-olds do, this is essentially a ledger account. It's only blank because I'm showing you a blank page rather than my actual entry page. This is a ledger account. It tracks all of the activity related to one of my accounts, cash. And rather than doing it kind of as a list of increases and decreases or positive and negatives to that cash balance, which is what I do in my checkbook, we typically tend to use T accounts to track. So rather than writing positive and negative, we have to know with our T accounts, is that an asset, a liability, or an equity account? If it's an asset account such as cash, What we're gonna do is we're gonna have our debits as the increases on the debit or left side. We have the positives or the increases to cash. And then every time we record a transaction and then we then post it to its T account, we post it in the right side or the credit whenever we're spending cash. So again, this is why it's really important to remember those debit and credit rules. We're not using positives and negatives, we're using debits and credits. So here's an example. Here's a journal entry where rent expense is increased by $9,000, right? Debit to increase an expense. And we incurred the expense. We also paid cash for that. So cash and asset is decreased. There's our journal entry with our debit and credit. Now in an accounting system where this would be booked in, let's say, SAP or Oracle, you would just hit a button and then automatically the account rent expense would be updated to increase. Whatever the balance was before for rent expense, it would then be increased by $9,000. Remember that a transaction is a change. The journal entry shows how those specific accounts changed. So we see here below with the cash account, we see the cash T account, and we see that $9,000 booked on the credit side. The cash balance decreased by $9,000. Rent expense increased by $9,000. These journal entries don't tell us what our final balances are. They tell us the change to specific accounts, ledger accounts. So remember, after each journal entry is recorded, the change to the accounts is recorded. It must be posted. Why? Because we need to get that final balance correct. Once I spend $100 cash, I have a new balance in my cash account. And there's another reason why we must post all of our journal entries to ledger accounts. Let's have Usher tell us that reason. All right, so what's the general ledger? A general ledger is the list of all of our specific accounts, not just all the activity in cash, up and down, increases and decreases to cash, but the increases and decreases for the period of all of our accounts: cash, accounts receivable, notes payable, accounts payable, long-term notes, revenue accounts, expense accounts. It's that culmination of all of that. So when we post our entries to the ledger accounts, the general ledger is updated. It's that grouping of all our specific accounts. Once the ledger accounts are updated to include all the journal entries, those ending balances in the ledger or the general ledger, those ending balances are used to create what's called a trial balance. And a trial balance is nothing more than a list of all of the ending balances. For balance sheet accounts, assets, liabilities, and equity, those ending balance will be at a specific point in time when that trial balance is prepared. For revenues and expense accounts, it will be the culmination of all of the revenues over the point in time for that accounting period. So here's an example of a trial balance. It looks a whole lot like it would be one of the financial statements, right? That gets reported out to investors, but it's not. The trial balance is not a financial statement. No one outside of the company is going to see this. This is for the preparers, the companies that are generating the financial statements. Before they generate the financial statements, they prepare the trial balance. They list out, you can see here, the balances in cash, receivables, supplies, and so on. Liability accounts, like accounts payable, unearned revenue, equity accounts, common stock. Then they have dividends, revenue, and expense accounts for that period. We make sure that all of the debits equal all of the credits. And then we use this internal only trial balance, just primarily for the accountants and the managers. From that trial balance, we then take that data to prepare the balance sheet and the income statement. So just to review the life of the business transaction, that's what we did in this video at a very high level. 1, record the journal entry. 2, post the journal entry to its ledger accounts. 3, prepare a trial balance based on the ending balances in all of the ledger accounts. And then 4, prepare the financial statements. Now that we've kind of summarized the whole process, we're going to take a look at all of it in much more detail in the future videos.